All right, hey everybody, thanks so much for tuning into Young Money Investments. My name is Cameron Bennion, and today we are going to talk about the number one question I think that I get on Instagram. That question is, how much money do I need to start investing? How much do I need to get this ball rolling? That is going to be the topic of today's video. Let's roll the intro footage and let's get to it. All right, hey everybody. So like I was saying, this is probably the topic that I get the most questions about recently. A lot of you that are starting to get into investing want to know how much money you need to start investing. And that is kind of a loaded question, to be honest with you. I want to keep this video short, sweet, to the point. I want to talk about a couple things that really do play a factor with that. One of those things being compound interest. A lot of you that are messaging me are probably in that 18 to 24-year-old age bracket. You have so much time to continue to build your wealth over time. And there's something really special called compound interest, which we're going to go over. That to me is like the eighth wonder of the world, as Warren Buffett says. It is a huge, awesome thing to have, because it means that all your money you have invested continues to grow more and more rapidly as time goes on. And with a lot of you being younger, that is going to be a huge key in order to making your money work for you. A lot of you that are going to be investing are probably not either not working a full-time job right now, or the full-time job that you currently have probably is not paying enough in order to support, you know, the lifestyle that you want to live. Now, with that being said, you need to learn to start saving. Now, whether that be 5% of your income that you make monthly, whether that be 10%, or even if that be 20%. Now, this is something that's interesting. If the government came and put a 20% tax on you tomorrow, you would kick, you would scream, you would fight it, but you'd end up paying it, right? It's taxes. You have to end up paying it. If I imposed a 20% tax on your income, you'd kick, you'd scream, and you probably would end up blowing it on different things. Look at your investments and see how bad you really want this. And I think what's going to be really important is, if you do have a significant other, look at your bills and look at what you're having to spend monthly, and see if you can set a little bit more aside in order to invest and put it into your investment account on a monthly basis, or save it as in cash in your brokerage account for if you're wanting to invest at specific times. Now, if you're wanting to swing trade, there's always basically good deals out there, especially right now. The current date is November 10th, 2018. The market has been very volatile, obviously, since all of October, and we still aren't really climbing out of it yet. And so there's a lot of great buys and a lot of great companies. We're in earnings season right now from Q3 earnings. And so there's a lot of good buys going on right now. With that being said, I usually recommend that people try to invest at least an initial investment of somewhere right around $500 to $1,000. If you're not investing more than that, it's going to be very hard to buy and diversify your account. I always recommend with people that are starting out to try and diversify a little bit, but don't diversify so much that you have like one share of Apple at $200 and one share of Tesla at $340. And then like 2 shares of Callaway Golf at $20, right? Like, you're not going to really see much growth in that. And so this is the hard thing in terms of diversifying your portfolio when you only have $500 or $1,000, is your gains on that are going to be very small, because the reality is even if, you know, I'm going to go with the number, you know, $1,000, right? You have $1,000. And we're just going to do 5% on that. That's $50. So 5%, a 5% gain on 1,000 is only going to bring you $50. And if you're swing trading, you're going to have some ups and your downs. 5% is not a lot. I mean, even if you were to make 10%, you know, in a month, which 10% would be 120% over the course of a year. 10% is a big gain in a month if you consistently can do that. And that's still only $100. So a lot of you are going to look at this, or you're going to look at what I've done. You're going to go, oh, well, I want to be making $1,000, you know, in a trade, or I want to be making, you know, a consistent $300 to $500 every day. That's just not going to happen. And I want to create kind of like a realistic idea of how much money you're going to put into it is how much money you can potentially get out, but don't forget about the downside as well. And so that kind of brings me into the idea of what your risk tolerance is, and can you hold through a recession? So depending on how you're going to get started, I like swing trading. I always recommend having some stocks that you hold long term, because the reality is even if we do have a recession and it lasts for 1 to 2 years out, as long as you hold those stocks and don't sell over the course of the next 5 to 6 years out, those stocks are going to be worth well over what they were at even during the recession. Now, this is why it's key to not invest money into your portfolio that you can't afford to leave in there for a while. Because if you then need it and you've taken, let's say you take a 15%, let's say it's a recession and you took a 30% hit on some of these companies that you're in, if you turn around and sell that, you just gave away money, because eventually those stocks are going to come back up if they have a good outlook. That's when you need to be putting more money in. And so I always caution people, be safe when you first start investing, to don't put so much money in that you can't afford to leave it in there for a period of time. That to me is a really important kind of philosophy with, especially with long-term investments, but even with swing trades as well, because sometimes my swing trades, I'll be down a little bit, and the swing trade will take a lot longer. There's several positions I can think of that happened to me. Secondary topic, or second bullet point, or third bullet point, it's probably my third or fourth bullet point, is going to be, do you have other streams of income that are going to be supplementing your trading? For 99.99% of you, you have to have another stream of income. That is where, so Fellow is the new brand, the new company that we just rebranded and restarted. It is an essential services company. As you know, we do ADT home security. So if you ever need home security, let me know, message me. We do DirecTV as well now. We do AT&T phone, so we can give you good deals on those kinds of things as well as pest control. So we do a whole lot of different stuff that's kind of rolling out. But this is how I made most of my capital that I was able to put into stock. So do you have a secondary or a third, tertiary or quaternary, do you have these different streams of income that supplement your trading? And if you do, that's really important. It'll take off some of the stress, but at the same time, figure out how to monthly either put that into a cash account where you have money sitting on the sidelines for some good buys, or continue to invest and take that percentage of your check that you earned and put that into these companies and in these trades. The big thing that I want to talk about as well at the end of this video is going to be compound interest. So what we're going to do is we're going to pull up here on the screen. Let's roll this over here. All right, so we got everything pulled up here on the screen, and this is where I want to talk a little bit about compound interest. Compound interest is huge, 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 because it means that your money continues to grow on top of the interest you already earned. So let's do a quick little example here. Let's say you were able to invest $1,000, which when I first started investing, I actually invested, I want to say $5,000 or $6,000 to start off with. Maybe some of you won't have those funds available to do that much money. But just as an easy example, let's do $1,000 here. So your principal investment, your initial investment is going to be $1,000. How much do you plan to contribute to your plan here on a monthly basis? Let's say, for example, you are able to invest, let's go with $100 a month, $100 a month. Shouldn't be too hard for most of you out there to invest $100 a month into this account. And we're going to do, for the sake of convenience here, we are going to do the course of 10 years. So I've been investing for 10 years now. Let's do a 10-year time period. Interest rate on this. The market average is 8.3%. I've averaged, before I started day trading and swing trading, I averaged about a 24% return annually. Let's say you can average let's say with the skills and techniques that I am going to be able to help you with, let's say that you can average a 50% return annually. Um, the range of interest rates, we're just going to leave it at 50. You're going to compound it. So that's going to be an annual compound. I can show you what it does if it's compounding monthly, and I can show you how much different that is. But this is what you end up getting here as a graph. So on this graph here, this is, and I wish we could zoom in a little bit more on this here, but this is a course of 10 years, right? When you invest your money here. At year one, you start out with $1,000 initial investment. You're going to be investing $1,200 basically every year, which is $100 a month. But this is going to be growing at 50% annually, which means every year you're going to be $500 richer on top of that. But it is going to compound. So every year it gets greater than the initial 500 here, which I think Rhett is actually just getting here. So what happens is you're going to grow it. The first year you are going to be at an investment of roughly, with your principal and your investments, $2,700. Your contributions to this is going to be $2,200, but you are going to have a total of $2,700, which means you got $500 in interest on your money. Year two, it gets a little bit better. You're going to have contributed $3,400, but your total is going to be $5,200. This is where it continues to grow. We get to year five, your initial contributions is going to be, your total contributions is $7,000, but your interest with that money total would be $23,418.75. You continue to go, year eight, you are looking at a total contribution of $10,600. Your total portfolio value would be at $84,738. And by year 10, you are looking at a total investment of $13,000, with your total account being actually valued at $193,661.13. This is how compound interest works. It is very crazy, even if you weren't able to make a 50% gain annually. Like I said, that is still a large amount, very doable and very possible. But if you're only able to do, let's say, 25% of that, we'll calculate that out on an annual return. You're making 25%. You will have, by 10 years, have invested $13,000, but still will have a total account value of $49,216. $49,216.71. You minus your investment that you've made in there, you will have basically made $36,216 in just trading alone, and you only had to invest $13,000. So that is the beauty of compound interest. Obviously, it starts slow, and that's why, year one, you only basically will have made, what is that? So you invested $2,200, you would have $2,450. That's a total of $250 you would have made that first year. But that $250 at year one, at the end of year one, ends up being a total of $36,000 that you end up actually making by year 10. And so that is why it continues to grow. And that's why compound interest is so, so crucial in terms of investing and being able to just make your money work for you. I mean, it just is, it's just kind of mind-blowing. To me, it's definitely mind-blowing. So I hope that example was actually really helpful on here. I hope that the compound interest calculator made sense. If you want to know how to do that, go to investor.gov. That's a government site. So it's a reliable source, very simple and easy. Like I said, just investor.gov. If you type in, I think, compound interest calculator, it's going to be like the third one up there. There's MoneyChimp, and then Bankrate, and then sorry, it's going to be the second one, compound interest calculator. It's investor.gov. So very simple and easy to find that. Hopefully that helps, and hopefully that helps you get a good idea of this. Growth is going to be slow at the beginning. It is not going to be easy. That's why I also still recommend using a paper trading account to kind of get the feel for these things, so that you can use larger account value and make some of these trades, and it makes you feel good that you've been able to make money. But realize the amount of money you put into this account is going to be contingent on how much your return can be. You can't just, people don't get 100% return overnight. These things don't happen. I'm happy with making 2% here, 3% here, 8% there, because it compounds, it adds on top of each other over time. And that's why as you move into these positions that are then $5,000 in a position, and 10,000, and then 20,000, and then 30,000 and 50,000, and someday you'll get to a $100,000 position and you will be able to make thousands off of these positions. And by then you're confident in yourself, you're confident in your abilities, you're not stressed out, you're not shaking like a leaf. Red always tells me a story of when he first got into some of his first trades. He's always like, I was shaking like a leaf. I was down like $100 in my first position. And, you know, you just be able to grow out of that. And then now he moves $1 million position. So it's crazy. It's crazy. So thank you so much for tuning in to Young Money Investments. Hopefully this helped. I'll talk to y'all later. Bye.